Welcome to the American Guy channel. While CNBC spent yesterday telling you silver was in a consolidation phase, while Bloomberg explained the market was finding support, while every mainstream analyst told you to watch the dollar, a price signal appeared that should have been front-page news across every financial outlet on Earth. And it was ignored. Completely. Shanghai silver futures hit $130 per ounce on February 19th. COMEX silver, $104. That's a $1.26 premium, a 25% premium for physical delivery in Shanghai versus paper futures in New York. Let that sink in. $26 for the same ounce of silver. One market says $130. The other says $104. Same metal, same day, same planet. The normal premium between Shanghai and COMEX, $2.36. That's the historical average. Transportation costs, logistics, normal market friction. But $1.26, that's 10 times the normal premium. That's not logistics. That's not shipping delays. That's not a temporary dislocation. Stay with me, because what I'm about to show you is not just a price anomaly. This is proof that the paper market has completely disconnected from physical reality. And this disconnect is being ignored by every mainstream financial outlet, because if they acknowledged it, the entire commodity pricing system would be exposed as fraudulent. This keeps me up at night. Let me give you the numbers. Clear, direct, undeniable. February 19th, 2026. SGE futures. Shanghai Gold Exchange, silver futures. $130 per ounce. COMEX futures. New York, $104 per ounce. The spread, $1.26. That's a 25% premium. Normal historical spread, $2.36. Current spread is 11 times normal. Not 2 times, not 3 times, 11 times. Now here's what makes this impossible in a functioning market. Arbitrage should close this gap in hours. Not days, not weeks, hours. Here's how arbitrage works in theory. Trader sees Shanghai at $130 and New York at $104. Trader buys silver in New York for $104. Trader ships it to Shanghai and sells for $130. Trader makes $1.26 profit minus shipping costs of maybe $3. That's $1.23 profit per ounce. With that profit margin, arbitrageurs should be flooding the market. They should be buying every ounce in New York and shipping to Shanghai until the prices converge. But they're not. The spread is widening. It's been persistent for weeks. Why? Because you can't get the physical metal out of New York fast enough to satisfy Shanghai demand. And you can't get it through Chinese customs in the volume needed. That is not a trade. That is a war. A physical war. Shanghai is screaming, we'll pay $130 for physical silver. And New York is saying, the paper price is $104. And the gap is 10 times normal because physical reality and paper pricing have divorced. So who's creating this? Who's causing a $1.26 premium that won't close? Let me be very direct. China, specifically the PBOC, the People's Bank of China. Here's the mechanism. And this is where it gets dark. The PBOC is implementing quiet quotas on silver imports. Not official bans, not public announcements, just bureaucratic delays, customs, inspections, documentation requirements, permits that take weeks instead of hours. Why? Because they want Chinese industrial buyers to source silver domestically at $130 per ounce, instead of importing from the West at $104. This isn't a supply chain. This is a chokehold. China is choking off Western silver from entering their market, forcing their own industries to pay premium prices, and hoarding every ounce of domestic and stockpiled silver for strategic purposes. But here's the genius of it. By letting the Shanghai price spike to $130 while COMEX stays at $104, they're accomplishing 3 things simultaneously. First, they're making Western silver look cheap on paper. $104 on COMEX creates the illusion that silver is plentiful, that supply is adequate, that there's no shortage. This keeps Western investors away from physical silver because the price signal says no urgency. Second, they're draining Western vaults at artificially low prices. While COMEX shows $104, institutions are quietly buying physical at $104, and it's disappearing to Asia. We saw 1.17 million ounces leave COMEX eligible yesterday. That's not random. That's metal moving east at suppressed Western prices. Third, they're securing industrial silver for Chinese manufacturers at $130, while the rest of the world is paying $104 in paper, but ain't get the physical. Chinese solar panel manufacturers, electronics companies, battery producers, they're paying $130 in Shanghai, yes, but they're getting the metal. Western companies are paying $104 on paper, but facing delivery delays of months. So who benefits? China secures physical silver for strategic industries at $130, knowing the real scarcity value is higher. Western paper holders think they own silver at $1.04, but discover delivery takes 6 months or never comes. And the PBOC stockpiles every ounce they can before the paper price catches up to physical reality. This is not inefficiency. This is strategy. And it has been ignored by Western media because acknowledging it would mean admitting the entire commodity pricing system is a lie. Now let me zoom out, because this is not just about silver. This is about the collapse of trust in Western financial infrastructure. The $1.26 Shanghai premium is a price signal. It's the market screaming that physical reality has diverged from paper promises. And it's happening across all commodities controlled by Western exchanges. Gold? Same pattern. Shanghai Gold Exchange consistently trades at premiums to London and New York. Copper? Same pattern. Shanghai pays premiums for physical delivery. Nickel? Same pattern. Remember the London Metal Exchange nickel squeeze in 2022? The LME canceled trades to protect short sellers. They literally rewrote the rules mid-game because physical delivery pressure was going to bankrupt Western institutions. This is the same playbook. Keep the paper price suppressed in New York and London. Let physical prices spike in Shanghai. Let the East accumulate at high prices that are actually below true scarcity value. And let the West trade paper that can't be delivered. History is clear on this. In 1971, Nixon closed the gold window. Why? Because France and Germany were demanding physical gold for their dollars and the US vault couldn't deliver. The paper promises exceeded physical reality. So Nixon ended convertibility. 1980, Hunt brothers tried to corner silver. They accumulated 200 million ounces of physical silver and demanded delivery. The CFTC changed margin requirements overnight. They crushed the Hunt brothers not because they broke the law, but because they threatened to expose that paper silver exceeded physical supply. 2008, MF Global. Customer funds supposedly segregated and safe. When MF Global went bankrupt, those funds were stolen to pay bank creditors. The courts ruled that customer claims were subordinate. Physical ownership didn't matter when the system broke. Now we're at the same inflection point. Shanghai at $1.130, New York at $1.104, a $1.26 spread that's 11 times normal, and Western media saying nothing. This is not just about silver. This is about the collapse of trust in Western commodity exchanges. This is about de-dollarization at the physical commodity level. This is about China saying, we don't believe your paper price. We'll pay $130 for physical, and we'll restrict imports to make sure we control the physical supply. And the West? The West is still trading paper at $1.104, thinking they own silver. They don't. They own promises. And when they try to convert those promises to physical, they'll discover delivery delays, premiums, and possibly default. Let me break the fourth wall. Let me talk to you man to man. I have skin in this game. I hold physical silver, not COMEX futures, not SLV ETF shares, not mining stocks. Physical ounces in my possession. And when I see Shanghai at $1.30 and COMEX at $1.104, when I see a $1.26 premium that's 11 times historical norms, when I see this spread widening instead of closing, I don't see confusion. I see clarity. The physical price is $130. That's what you have to pay to get the metal in the world's largest silver consuming market. The paper price is $104. That's what you pay to own a promise on a screen. So which price is real? If you think $104 is the real price, try this. Call a bullion dealer in Shanghai. Ask them to sell you 1,000 ounces at $104. See what they say. They'll laugh at you. They'll tell you $130 minimum. Because that is the physical reality. The $104 COMEX price is a fiction maintained by paper contracts that outnumber physical ounces by ratios we talked about yesterday. 7.4 to 1. 7 paper claims for every physical ounce in registered inventory. And now we have proof that the physical price is 25% higher than the paper price in the market that matters most. Now, I don't know the exact date this breaks. I don't know when COMEX defaults or when the paper-physical disconnect becomes undeniable to everyone. I can't give you March 15th at 2 p.m. But I can tell you the trajectory. I can tell you that a $1.26 premium that won't close despite arbitrage pressure means physical supply is tight. I can tell you that China implementing import quotas means they're hoarding. And I can tell you that when the West finally wakes up and tries to claim physical silver, the delivery delays and premiums will make today's $1.26 spread look small. So here's my position. Not financial advice, my position. I'm holding physical. I'm not selling a single ounce until the COMEX price reflects Shanghai physical reality. That means I'm not selling until COMEX hits at least $130. And even then, I'm watching to see if the spread widens further. Because if Shanghai is at $130 now with quotas limiting imports, what happens when those quotas tighten? What happens when Western industrial buyers realize they can't get delivery? What happens when COMEX registered inventory continues draining? The physical price goes higher, much higher, and the paper price either catches up or the exchange defaults. Let me summarize this. No fluff, just facts. February 19th, 2026. Shanghai silver futures at $130. COMEX silver futures at $104. Spread of $1.26. Now that's 25% premium. That's 11 times the normal historical spread of $2.36. The mechanism: China implementing quiet import quotas through customs delays and bureaucratic restrictions, preventing arbitrage from closing the spread, forcing Chinese industrial buyers to pay $130 for physical while securing domestic supply for strategic purposes. The villain, the PBOC. But also Western bullion banks suppressing COMEX price at $104 with paper contracts, while physical drains east at that artificially low price. The outcome? Physical silver is already at $130 in the world's largest consuming market. The paper price at $104 is a fiction that will either catch up or the exchange will default when delivery is demanded. The timeline, unknown. But the spread is widening, not closing. Arbitrage isn't working. That means physical is scarce and getting scarcer. And here's my final warning to you. Stop watching the COMEX price as if it's real. Stop thinking that $104 on your screen represents the value of physical silver. It doesn't. The physical value is $130 in Shanghai. And it's likely higher in private transactions where premiums aren't reported. Stop listening to CNBC telling you silver is consolidating. It's not consolidating, it's bifurcating. Paper is $104. Physical is $130. And that gap is going to widen until paper holders realize they've been trading promises while physical holders have been accumulating the actual metal. Don't listen to the words. Watch the flows. Watch the premiums. Watch the arbitrage that won't close despite massive profit opportunity. The Shanghai premium is telling you everything you need to know. Physical is scarce. Physical is valuable. Physical is moving east. And paper? Paper is a promise that's 25% below physical reality. When that gap closes, it closes up, not down. COMEX moves toward Shanghai, not the other way around, because you can't print physical silver, but you can print paper contracts. And when the paper contracts try to claim physical delivery, the premiums, delays, and defaults will make today's $1.26 spread look like a warning we should have heeded. Physical is real, paper is fake. Shanghai is at $130, COMEX is at $104. And that $1.26 spread is the most important price signal in the silver market right now. This is the hidden economy. Stay stacking. This is the American Guy. February 19th, 2026. Shanghai at $130. COMEX at $104. The spread is 10 times normal. The arbitrage won't close, and Western media is silent. Welcome to the American Guy channel. Like, subscribe, and share this with someone who's still watching the COMEX price thinking it's real. Because they're watching paper. You're watching physical reality, and that makes all the difference.